So Canada, as you may know, really has two main products for funding. We are a one class of senior jurisdiction, so we have no senior preferred. We just have bail-in, and we have covered bonds. And so when we have big funding years, we really like covered bonds. So this year has had a few dynamics that are going on. One of them is we have quantitative tightening going on in Canada, and quantitative tightening is reducing the size of deposits relative to loans, and so that's increasing the size of our funding programs, relatively speaking. And it's happening at a time when the relative value of covered bonds relative to senior is just at its all-time high. So covered bonds are very attractive to Canadian issuers to fund that extra balance sheet growth which is required as a result of quantitative tightening. And I think you're seeing a lot of interest in the product that stems from that. So Canadians travel in packs. So we are all kind of looking at the same relative value, and so when one of us sees something that we like, I'm sure you can expect 3 or 4 other Canadians to see the same thing. And so partially that's been the sterling market, but it's really been global. It's been a big year for covered bonds for Canadians for a couple of years running due to quantitative tightening dynamics and the attractiveness of the product. And sterling is just really a part of that. And so going forward from the Toronto Dominion, I think what we can expect is that covered bonds are going to be a core part of our funding program, that we're going to look at things on a relative value basis, swap back to Canadian dollars, and that when certain markets are relatively attractive, you're going to see a lot of Canadians in those markets. Yeah, well, that's a good question, actually. I was just talking about this with a colleague the other day. It really is a hurry up to slow down market the way that it works. I don't think that that's because trades don't work more broadly, but it's a sector which has outsized presence from Canadians and Australians, and so you get this Canadian traveling in packs kind of dynamic which happens where Canadians like it or they don't. But I also think you're seeing the same thing from issuers. So you have an asset manager community in the US, which is a little bit smaller, and a lot of the demand comes from overseas bank treasuries. So that can be impacted by basis swaps. Our interest can be impacted by basis swaps. And so I think it's a trade that regularly works, but sometimes it doesn't work in the sizes that you can get at the right moment. And so when the right moment strikes, and there's a lot of interest from investors, and there's a lot of interest from issuers, you'll get a lot of interest back to back to back. Everybody wants to get it while the getting's good, and then that creates this flurry, and then there's a little period of exhaustion, and it backs off a little bit. So I do think it's accurate to say that basis swaps and how they're working in the U.S. market are a factor, both on the issuer and on the investor side. So it's just kind of a feature of the market, but I don't think that's necessarily reflective of the market not being there all the time and not being a robust and liquid market, because I really think that it is.